This section is going to focus on some characteristics around trading the British pound US dollar cross and to a lesser degree the euro US dollar cross, in particular price action and behavior around options protection levels and what we call the figure. Just going to give you a brief overview of what options are and some of the options that are used in the foreign exchange with foreign exchange instruments. In general, an option is a security whose price is dependent upon or derived from one or more underlying assets. The derivative is a contract between two or more parties and its value is determined by fluctuations of the underlying asset or currency. There is a multitude of strategies that can be employed using options, and they can be very, very complex as well. If you want more information on that, there's a book called Options Made Easy by Guy Cohen. Just to give you some background on options protection, as you recall, we trade spot forex, and spot options allow you many choices and flexibilities depending upon your objectives in the foreign exchange market, because remember, you might be a speculator while somebody else may be a hedger, while somebody else may be using foreign exchange instruments to protect large sums or corporate assets. There are standard options. There are one-touch spot options where you receive a payout if the price touches a specific level. No-touch spot options where you receive a payout if the price does not touch a certain level. Digital spot where you receive a payout if the price is above or below a certain level at expiry. Double one-touch spot where you will receive a payout if the price touches one of two set levels before an expiry date. And finally, there's double no-touch spot options, or you may see them referred to as DNT options in your newsfeed, where you receive a payout if the price doesn't touch any of two set levels. And now we're going to see why some of these various options are important while we trade speculative spot foreign exchange. Options protection is a term used in the foreign exchange sector when a participant is holding a large options positions that may be what we call knocked out or touched at a specific price level before expiry. This applies primarily to no-touch spot options and double no-touch spot options. The risk to the option holder is that if the level is touched before a specific time or date, also called expiry, the option becomes worthless. So just to recap here, we're looking at options protection of no-touch options, because if they are touched, they become worthless. Banks and large financial institutions can hold significant position sizes in no-touch and double no-touch options for various reasons that, of course, will meet their corporate objectives. When the market begins to trade close to the level where they may have a very large interest or options position and stand to take a considerable loss if that option is touched, then the holder of the position will aim to protect that level by moving flows into the market to drive price away from the specific knock. Why do I care? On Euro US dollar and pound dollar, those two crosses in particular, the options knockout level is typically at a rounded price point, also called the figure or half. Example of the figure, in the euro dollar would be 120, 120, 100, 120, 200, etc. While in the pound it's 17500, 7600, 7700, and so on. The half ends in 50. So on the euro dollar, it would be 120.50, 121.50. On the pound dollar, it would be 175.50, 76.50, etc. These levels are focused on, to a lesser degree, really, the 5-0 level. But you should note the figure because really you want to anticipate a bounce at the figure or for that level to hold, particularly during thin liquidity. Because during thin liquidity, the level is more likely to hold. There's a higher probability of options protection to be enforced when the market has not achieved a specific price level for quite a while or for some lengthy time period. There may be an increase in options at that level because it's been so much time since it's been to that level, and because the market believes that that level will not be touched before expiry, of course, which is why they've taken the position. Therefore, if the market approaches the no touch or double no touch level, whoever it is that holds that position may have a significant interest to protect that position, and they will protect the position the closer the time it is to expiry. So if we're nearing expiry, say in the same trading day, then the entity may drive price away by bringing flows into the market to drive price away from that level so that their option can expire and return them a nice profit. Have a look at your news feed because you may see notes coming in concerning options protection levels, and that can potentially help you to identify levels that may be protected or where you may see a bounce. Especially if these levels have not been achieved in some time. Why do you care? Well, you're a technical analyst, and as we're watching price, you want to watch to see if price is going to bounce at one of these levels. So what do you do if the market is making new levels and you see a significant level of resistance or support also that converges with the figure? It is certainly a trade possibility, as we'll see. You can look for a trade that may involve options protection when the market is making new levels and approaching a figure, when the currency pair has already been on a long run or had a big move for the intraday trading day, and if the maximum range has been stretched and we start to approach the figure, look for a bounce. Also look for the figure to converge with other key technical factors like pivot points, trend lines, support, resistance, moving averages, and so forth. Here are some examples of price bouncing at the figure, and this is a 4-hour chart. This is not a small time frame. This is a 4-hour chart. Look at price here at 7,500 as price had come down to 7,500. Look at the nice bounces. Here we bounce all the way up to 7,600 and bounce back. Again, it respects 7,500 and so forth. Then price moves down to 7,400. Look at the consolidation for several trading sessions above 7,400 before the breakthrough. A bounce at 7,300. Here again, a bounce as price comes down again, 7,500. Because these are 4-hour closed candles, we don't know how much price would have bounced on the smaller time frames, but we will be looking at some smaller time frames. Here price moves through 7,300. Maybe they slipped through some options protection and then bounced. We bounce up to 7,600 and look at the tweezers at 7,600 before a nice move down. 7,400, 7,500 a bounce, 7,600 a bounce, and all of these bounces are very, very generous bounces. And why I say that is because the bounce just at the figure can give you a nice profit if you trade as close to the figure as possible. 7,800, 7,900, a nice bounce. Price stops at 7,800. Look at the bounce at 7,800 here before it moves through, and so on. Another 4-hour chart, 8,200, 8,100. Look at the bounce. We bounce at 8,100, 8,250, struggles to get below. 8,100. Now, what I want to point out here is this, is that we had a real nice run from 8,100 to 8,400, and remember how I said as price is making new levels from this time period over here and earlier, we may have seen no touch options levels building at 8,400 while the participant speculated that price was going to fall and continuing to fall and would never touch this option level. Well, look what happens when price comes up to 8,400, and look at the response at 8,400. And whether or not no touch options levels are related to the bounces or not, it is quite a natural occurrence and frequent occurrence and tradable occurrence that price bounces at the figure on the pound dollar cross. 8,100 again. Clearly 8,100 is an important level for some reason at this time. 180, 180,300 to bounce. 8,300, 8,300, and so on. 190,200 bounced. Again, we're looking now at a 4-hour chart, so it's not as though we've just seen a small bounce on a 15-minute chart. We're looking at a 4-hour chart, and if we see big moves off a 4-hour chart, they are typically very, very tradable on the smaller time frames. 190, 189, 188, 187, 186. You see here how we're moving to new levels with each of several trading sessions, but we keep moving lower and bouncing at the figure. 86, 85, hard to say if it bounced there. 84, moved through and became resistance, and here is 82. 83, 82. You'll see in my live trading examples, and also in a lot of the pro traders reviews, and in some of the simulated scenarios here, you will see that the market repeatedly in the British pound US dollar cross bounces at the figure. This is a 60-minute chart. To give you an example, these vertical lines separate the days. Price moves up from 77.40 to 7,900, so it moves 160 pips. The more it moves in a day, the closer it comes to the figure, the higher the probability it will bounce. So here we see a bounce at 7,900, and look at just the bounce alone goes from 7,900 to 7,820. These often will lend to quick profits. Another 1-hour chart. Price comes up here, 7,600 is the base of support, and we move all the way up to 7,800, double top at 7,800, and fall. Even just the initial double top at 8,700 moves to 77.20 before coming up for a retest and then falling. The second attempt is often also a place for good trade. I like to try and get it on first attempt if price looks like it's weak. Now here's a 60-minute chart looking at several days move. 7,800, 7,700, 7,600, not much action. 7,500 and 7,400. Nice bounce. Even on this bounce at 7,500, it looks to me like the market went about 45 to 50 pips. As price makes new levels, the higher the probability of a nice bounce. Another British pound chart. The figure as support, the figure as support. But as we're making new levels for several days in a row, 8,500 becomes a clear level of resistance. Even 8,400 right here, trading 8,400 here. Price came back about 40 to 50 pips here. Struggled to get through. Nice bounce at 8,500. How to make money at the figure? Well, we know that, and I am convinced, that price bounces at the figure, particularly when price is breaking new ground, making new highs and higher highs and higher lows, or lower highs and lower lows, making new price levels. We know the market has a predilection to bounce at the figure, pound dollar or euro dollar, mostly the pound dollar. And the other thing about the pound dollar is that it moves in bigger ranges, so it allows better opportunity to make some faster profits. The figure is a natural level of resistance and support. Look for the figure to converge with other discretionary tools such as pivots, fibs, support, resistance, trend lines, and other factors. Like any other technical level, the figure can be inconsequential at the time of major data releases or news releases. So don't look at it as a distinct technical level when a major economic report is coming out, because when major economic reports come out, they can completely disregard any technical factors. The figure can become particularly sensitive to a bounce if price has moved well beyond maximum projected range for the day. What that means is that if the figure has moved, had a large move, if the pound dollar has had a large move and it has moved at least 25% but closer to 50% beyond the average true range for the day, look for the figure as a significant level or a key level at which you can make a trade. The figure is just one more tool that you can use to expect the market to bounce, and it's also, like all of your other tools, or the majority of the tools that we've presented here, it is a leading indicator. So it is an area at which the market can bounce that you know in advance, rather than a lagging indicator, which is momentum generated. Again, if price is moving toward a figure that it has not seen in a while, there's a higher probability that there will be options protection, or that this level will be sensitive to the market, and the market will want to protect that level, or you'll simply see a decrease in buying interest if it's on the long side, or selling interest if it's on the low side, and a higher sensitivity to the market, lending to a bounce.